Daniel Lacalle, chief economist at Tressis, is still with us out of Madrid. And Daniel, you commute between London and the Spanish capital. Does that change now post-Brexit? What differences do you see?
Well, thankfully, it does not have any implication for me, and so I'm quite happy, and I'm quite happy about this deal because I think it's very good for the European Union and it's very good for the United Kingdom. I think that if we look at this deal, it's significantly better for the UK economy than the one that was announced by Miss May a few years ago. It's also much better than, obviously, as we just heard, a no deal. No, I think that one of the big things that remain under question is the role of the financial sector and how the relationships between the European Union and the financial sector are going to continue into 2021. Because that's one of the areas that, in my opinion, surprisingly was left with less detail relative to others that have been extremely detailed, like, for example, fishing. So I would say that the biggest uncertainty right now remains for the city and for the role of international banks and the clearing houses in the relationships and the financial relationships with the European Union.
Nonetheless, you're not exactly bullish European assets, Daniel. I mean, a lot of people would say, okay, the U.S. has real problems with coronavirus. They've got a new administration coming in. They've got, as others believe, a weakening currency against the backdrop of a Europe that looks cheap in terms of value and has this rescue plan that successful world leaders like Angela Merkel and Ursula von der Leyen are surely going to distribute well. Why are you not bullish European assets?
I think it's very simple. The mirage of European earnings growth always ends up badly, sorry. I think that if we look at European earnings estimates for 2021 and 2022, they are extremely optimistic, and we're going to likely see massive downgrades to those earnings. I think that in any case, relative to the US stocks, European stocks always look optically cheap. Why? Because of the composition of the indices. It's basically banks and large conglomerates. However, the level of growth of those companies is extremely limited. And more importantly, in 2021, most of those companies are going to devote all of their action into defending their balance sheet, not on delivering higher earnings growth. Therefore, if you want to invest in Europe, it is much better to invest in fixed income rather than in equities, in which the risk of earnings downgrades is much higher than in the United States. There is in the United States, but in the United States, at least you have the cushion of buybacks, whilst in the Eurozone, you still have significant stock burden because of many companies that will issue shares in 2021 and 2022, but fundamentally because the hopes of a rapid recovery plus a very aggressive impact of the European Recovery Fund are extremely optimistic. Let's remember that the European Recovery Fund is positive. However, we must also remember that the 2009 growth in jobs plan and the Juncker plan did not deliver on the levels of growth that were expected. So people are betting too much on a multiplier effect. That has never happened.
I suspected you might be skeptical of that. Daniel, we're going to have to get you on again soon. Thanks so much for joining us. Daniel Lacalle, chief economist at Tressis. Merry Christmas, and I wish you a happy new year.